For generations, we've been told the single best way to build wealth is to buy a house. It was the golden rule. But what if I told you that in 2026, that rule is not just broken, it's become a potential financial trap? The math has completely flipped on its head. Today, we're going to run the new numbers and show you why.
You've heard this a million times, right? Renting is just throwing money away. It's what our parents told us, what their parents told them. And for a long time, look, they weren't wrong. A mortgage was a forced savings account, and rent was, well, just gone. But that was a different world, and the entire economic landscape has shifted under our feet.
And this slide right here says it all. This is the new reality, plain and simple. Back in the day, with low interest rates, it took about 5 years for owning to become more profitable than renting. That was your break-even point. But in 2026, that break-even point has absolutely exploded to over 13 years in many cities. Why? High interest rates and flatlining growth. This one change, this single shift, rewrites the entire playbook.
So how in the world did we get here? Well, it's not just one thing. It's a perfect storm of economic shifts that have created what we're calling the new 6% reality. Let's break down exactly why those old, comfortable assumptions just don't work anymore.
First up, the big one, the cost of money. The party is over. That era of rock-bottom 3% interest rates is gone. The new baseline, the new normal for a 30-year fixed mortgage, has settled right around 6.3%. And you have to understand, this isn't some temporary blip. This is the new cost of capital, and it fundamentally changes the long-term cost of owning a home.
Okay, so money's more expensive. But hey, at least your house is appreciating like crazy, right? Well, not anymore. This is the second gut punch. Top analysts are forecasting 0% national home price growth. Zero. So that rapid appreciation that used to make up for high costs, it's vanished. In fact, after inflation, your home's value might actually be going down.
And here's the third piece of the puzzle, and it's absolutely crucial. It's called opportunity cost. While your money is locked up in a house that's going nowhere, the stock market is projected to return 12%. Think about that. Every single dollar you pour into a down payment, interest, and taxes is a dollar that's not compounding for you in the market. That gap is the secret engine of this new math.
Now, I know what some of you are thinking. I'll just buy now and refinance when rates drop. You have to be careful with that thinking. That's a gamble, not a strategy. The market is stabilized. The new cost of capital is around 6%. You have to make your decision based on the reality we live in today, not on the hope of a 3% world returning.
But you know what? The mortgage rate is only what you see on the surface. It's the tip of the iceberg. Underneath, there are these hidden costs, these silent wealth destroyers that are eating away at homeowners' finances faster than ever. Let's dive into those.
Get a load of this number, $16,000. That's how much the average homeowner is spending every single year on things that are not their mortgage. That's an enormous, ongoing cash drain that almost nobody properly accounts for when they're dreaming of buying a home. We call these unrecoverable costs, but let's just call them what they really are: burned money. It's cash you set on fire every month. It's the mortgage interest, the property taxes, the skyrocketing insurance, the new water heater. Poof, it's gone forever. It never builds a single cent of equity. This is the true cost of owning. And the crazy thing is, these burned costs are inflating way, way faster than everything else. Just look at this chart. General inflation, the CPI, is chugging along at 2.4%. But home maintenance, that's up over 6%. And home insurance, it's just through the roof, soaring 10, 15, even 20%. Home ownership has become this uniquely expensive thing to maintain.
And speaking of insurance, we have to talk about the crisis that's unfolding. This is a true black swan event for real estate. Huge insurance companies are literally packing up and leaving entire states like California and Florida because of climate risk. They're creating this whole new category of uninsurable homes. And here's the absolute killer detail. If you can't get insurance, you can't get a mortgage, period. This isn't a future problem. It's happening right now.
Okay, so we've laid out this new kind of scary reality. So let's put it all together. Let's run the numbers and put a homeowner head-to-head against a disciplined renter who invests the difference. Let's see who really comes out on top.
So let's take a case study, maybe in a market like Miami. The homeowner's all-in cost is about $6,500 a month, most of which is just burned on interest and taxes. Meanwhile, their asset, the house, is growing at 0%. The renter gets a comparable place for $3,500. That leaves a $3,000 surplus, every single month. They invest that surplus. The result? After 10 years, the homeowner has a tiny sliver of equity in an illiquid asset, while the renter has built a significant liquid investment portfolio that's been growing exponentially.
And there's a simple metric that proves this out: the price-to-rent ratio. Think of it like a PE ratio for a stock. It tells you if something is overvalued. Historically, the rule of thumb was if this ratio gets above 15, it's smarter to rent. Well, in 2026, you've got cities like Austin and Miami with ratios over 23. That's completely disconnected from reality. It means the price of owning is just totally out of whack with the actual value you're getting.
So here's the bottom line. When you actually run the numbers for 2026, the disciplined renter-investor doesn't just come out ahead. They blow the homeowner away for at least the first decade, maybe even 15 years. That opportunity cost, the penalty for locking your money in a stagnant, high-cost asset, is simply too massive to overcome.
Okay, so what do you actually do with all this? The point of this isn't to scare you or say never buy a house again. The point is to be smart, to make a data-driven decision, not an emotional one. So let's build a clear, simple playbook for how to decide in 2026.
Buying a home is no longer the default option. It's a very specific choice for a very specific situation. You should only buy if you can check every single one of these boxes. 1, you're staying put for 10+ years, period. 2, you're buying in a stable, less bubbly market, think Midwest, not Miami. 3, you've personally done the homework and confirmed the house is insurable long-term. And 4, you're honest with yourself that you value the lifestyle more than the financial return, because the return probably won't be there.
On the other hand, renting is the clear, smart financial play for most people in 2026. If you live in an expensive city, if you think you might move for your career in the next 5 or 7 years, and this is the most important part, if you have the discipline to take that money you're saving and invest it every month. If you can do that, you build real wealth while avoiding all the new risks.
Which leads us to one last pretty provocative question. For this new era we're in, with this new math, what if the best way to build wealth from the housing market in 2026 is to not own a house at all? What if renting smart and investing the difference is now the superior path? The math as we've seen today suggests the answer is a resounding yes.